All right, so chapter 18 talks about long-term debt financing. So this topic is not new. Long-term debt financing, always when you hear this, it means debt, and debt means bonds. Bonds means when company issue a piece of paper to sell it in order to get money. So this is what long-term debt financing is. And in this chapter, we will explain how a multinational company use debt financing. Normally, every company uses debt financing, but if you are an MNC, you have to consider an extra thing, which is in a manner in order to minimize your exposure to exchange rate risk. And secondly, you want to explain how an MNC may allocate or assess potential benefits from financing with low interest rate currency that differs from its cash inflow currency. Because being an MNC, you have an advantage over a non-MNC. Why? Because if you are an MNC, you exist in many different countries, like Grab, right? Grab is very big, and Grab can benefit from financing from different countries. So, uh, why they can actually get funding in the US, why they can get funding in Singapore? Why? Because they have became an MNC and they took full advantage of that by getting low interest rate uh, financing countries. So next, we want to explain how an MNC may determine the optimal maturity when obtaining a debt. Means to decide how long to borrow. Also will relate to the exchange rate risk. And finally, to explain how an MNC decide between using fixed rate against a floating rate debt. So when you borrow, you can decide whether the interest rate that you pay is fixed or floating. All right, this applies to many kinds of loan. I remember many years back when I bought my first car. I needed to take a bank loan. So the bank officer came over and they gave me a document to sign. Then just said, "Oh, you flip to every page, you sign every page." Then I look at her. Then can you explain to me about the interest rate? Then the bank officer looked at me and say, "Oh, okay. The interest rate is so and so, and every year you need to pay so and so." They say, "Oh, okay. So the interest rate is fixed, is it?" The bank officer say, "Yes, interest rate is fixed." Then I asked back, is there an option? Opt? Can I choose floating?" Then the bank officer say, yes, you can, but do you want floating? Then I said, no, I don't want floating, but I just want to have the option. I just want to know that I can choose floating if I want to. But because they want to make their job easier, they do it without asking. They just go for fixed and they assume that you don't know. So actually, even in bank car financing, you can choose fixed or floating exchange rate. So interest rate. And the difference being fixed means fixed, means if you take the loan for 9 years, your interest is 5%. Means for 9 years you will pay 5%. As for floating, it will go for a base lending rate, which is the minimum of 4%, and then they will give you a floating amount of, let's say, plus 1.5. So in total, you pay 4 plus 1.5 is 5.5%. But when you opt for floating rate, in the future, when the base lending rate or when the uh, central bank cut the interest rate, they want to make borrowing or lending cheaper. They cut the interest rate, so your base lending rate from 4 it can drop to 3. And when the base lending rate is 3, what you borrow, you only pay 3 plus 1.5, which is 4.5. So it's much lower than the fixed interest rate if you opt for floating. So do consider that for the cases like car, houses, these are small matter. But in terms of corporate financing, when you borrow huge amount, then fixed or floating plays a very big difference. Okay, so in terms of long-term debt financing, subsidiary of an MNC commonly finance their operation with the currency in which they invoice their product. So usually they try to keep their inflow and outflow the same, right? Because outflow means how much they need to repay for their debt. Means they borrow how much in dollar, they need to earn that much in dollar to pay back their loan in dollar. And that is the most straightforward way. Otherwise, I have friends who work overseas, right? They work in, let's say I have friends who work in South Korea. They work as an engineer. They earn quite a lot in South Korea. But then the problem is he has a family in Malaysia and he bought a house for his family in Malaysia. So now the problem comes. He said, you earn so much, but what is the problem? So his problem, he told me, is he earns a lot in South Korea, but the money or investments that he has is in Malaysia. So the problem is when he convert this money back to Malaysia. Why? Because every time he earns and he wants to pay the loan in Malaysia, he will always have a lot of uncertainty, especially in terms of exchange rate. Okay, for example, this month he earns in Korean won and he wants to pay the the installment in Malaysian ringgit. So Malaysian ringgit installment is fixed, is let's say 2,000 ringgit. But in Korean won, the exchange rate changes every day. So 1 month he will pay like he will need to pay let's say 100,000 won. Okay, 100,000 won. And then the second month he will pay about 120,000 won. And then the third month he will pay about 90,000 won. So every month he pay a different rate to pay his loan in Malaysia. So the question is why? He somehow find out himself. He is not a finance guy. He is a IT guy. But sooner or later he understood that, oh, because of exchange rate fluctuation, that causes him every month he pays differently. So for him, it's very uncertain because he needs to convert Korean won back to ringgit to pay his loan. Right? So if that is just a small amount, this one just 2,000 per month, what happens to corporate loans when they borrow millions and millions and every month they finance this kind of loans? Like if you borrow overseas, then you need to repay back in a foreign currency. Then every month you will pay a different amount just to finance your loan. So that is very troublesome, right? So last year, probably when the exchange rate is good, your profit is high because you pay your installment very cheaply. But this year, when the exchange rate is not in your favor or not so good, it seems, then your profit will be affected, your profit will be worsened. But it doesn't reflect the performance of your company. Perhaps this year, your performance of the company was even better than last year. But this year, due to exchange rate fluctuation, your performance, your profit was less than last year. And then your owner question you, hey, why are we making less profit this year when supposedly this year we supposed to be better after the pandemic? Why are we performing worse? Then you can explain. You explain that you give an excuse that, oh, because of the exchange rate, that's why we borrow in that currency and we earn in another currency. So because of that, it affects our profit. And this is a very weak this is a very weak excuse because you as a upper management should be aware of this matter and you should have taken the right steps to prevent this from happening. So this kind of fluctuation who makes your company looks bad, it should have been managed from the start. All right, unless you are very low income and you don't know about this, then then you cannot blame you. But if you are in the upper management, you should have foreseen this and should have taken the right uh, precaution to prevent this from happening. So an MNC cost of debt affects its required rate of return, especially when you use that for proposed project. Therefore, the features of debt such as currency, denomination, maturity, and the rate of whether it is fixed or floating can actually affect the cost of debt wherever you are going to borrow your debt, right? If you are starting a business in Korea and you want to borrow from Malaysia, then there are a lot of things to consider. Therefore, if you do that, you will definitely affect the feasibility of projects that you are going to finance with debt. All right. So an MNC usually uses long-term funds to finance long-term projects. This is what we call as a matching strategy. So question will be, why don't you finance long-term project with short-term funds? This is problematic because if you only borrow 1 year, but your project is expected to run for 2 years, then what happens after 1 year, right? What happens after 1 year when your debt is already due? You have to pay back, but then your project is not done yet. So the best way to prevent this from happening is to match the timeline of your project with your loan. Like, just say your PTPTN. You do, for those who's taking study loan, PTPTN. You take this loan so that it covers your studies, right? So your studies, when to start, when to finish, you need to inform the agency so that when you finish, then you can start repaying, right? What if you what if the time is different? That means before you complete your studies, you already have to repay your loan. Isn't it bad for you? You wouldn't be able to study and also pay your loan at the same time, right? So this is the same rationale, same reason behind financing matching with the timeline of the project. So reasons to match the currency is also to reduce subsidiaries' exposure to exchange rate movement because it allows subsidiary to use portion of its cash inflow to cover the cash outflow to repay its debt. So one reason, like US company, they open a subsidiary in Philippines, and when they open this new project in Philippines, they need money, right? So in Philippines, they can have a option. In Philippines, this project, you can have an option to either borrow the funds in Philippines, which is very expensive or very high interest rate, or you can choose to borrow from US, which is your home country, where the funds is cheaper. So if you borrow from US, no problem, it's cheaper. But you have to remember that this project is based in Philippines and your cash inflow will be in Philippines currency. So how do you repay your debt? You have to convert the pesos you receive from Philippines to repay your debt in the US. So not to say it's complicated, it's not complicated, but it's subject to exchange rate risk, unnecessary exchange rate risk. So the best way is to reduce this exchange rate risk by taking a loan from where you do your project. So although Philippines interest rate might be higher, but you can reduce the exchange rate risk by taking a loan from Philippines. All right. So next, being a matching strategy is especially desirable when foreign subsidiaries are based in countries where interest rates are relatively low. So that example I gave you was because subsidiary in Philippines and interest rate is high. Then you have a headache. Should you borrow in Philippines or US? But if the subsidiary that you are working in, let's say in Japan, your subsidiary is in Japan, there wouldn't be a problem to decide where to borrow, because in Japan, typically their interest rate is also low. So when you operate in Japan, just borrow in Japan. Save the problem, because Japan interest rate is low. And not only that, when you borrow in Japan, operate in Japan, you avoid the exchange rate risk. All right. So one way that a multinational company can reduce or hedge their exchange rate risk is using a currency swap. Okay, this is needed especially when they want to manage their risk. Why? Because they borrow and their income is in different currency. Example, they borrow in USD, but their income is in peso, in Philippine peso. So their income and their outflow is in different currency. How do you reduce this risk? You can opt for a currency swap. A currency swap strategy basically specifies the exchange of currencies at periodic intervals and may allow MNC to have cash outflow in the same currency in which it receives most of its revenue. And what does currency swap mean? Okay, so to understand a currency swap, I would bring in two companies, Miller and Beck. All right, Miller and Beck. And this example is just for you to understand. All right, so if you look at Miller company on the left, this company is operating in Europe. Okay, this company is operating in Europe and they receive payment in Europe. Okay, but now you know that Miller is going to have problem because they receive payment in Euro, but their investors are from US. They want dollar. Okay, for Beck company number 2, they receive payment in dollar for their business, but their investor need euro. So you see there's no problem. If there's an exchange rate market, what you receive in euro, you just need to convert to dollar to pay them. If you receive dollar, you just need to convert to euro and pay your investor. Not a problem, not a big problem basically, before you learn this subject. But after knowing about the severe impact of exchange rate risk, that means if you receive euro and what happens when the exchange rate between euro and US dollar changes significantly. When the exchange rate changes a lot, then the payment will be highly affected. When it's highly affected, not because of your performance, but based on your inability to manage this exchange rate, right? So in this case, we want to focus only on managing exchange rate risk. Okay, so if you have euro income and you have outflow in USD, that means your inflow and outflow is in different currency. So same goes to Beck and Miller. Beck, inflow in dollar, payment in euro. So if Beck and Miller meet each other, Beck and Miller can come into an agreement to perform a currency swap agreement. So currency swap agreement, why is that? Because you see, Miller received payment in euro. All right, and their investors don't need euro. However, the investors of Beck, they need euro. So what they can do is they receive euro, they pass this euro to Beck so that Beck can pay their investors. So that is a cooperation. That means Miller sees back and then say, hey, back, you need euro. Then my euro, I will give it to you. And then you can use it to pay your investor. Back also very happy. So back will ask Miller back, okay, so this arrangement is very good. So what do you need? Miller tells back that you receive payment in dollar, right? You give me this dollar because I want this dollar to pay my investor. So you can see that once they discovered that each of them have the same needs, okay, of currency. That means one currency need euro, another currency needs, another company needs dollar. They can perform a swap. And the swap doesn't mean, hey, your $1 exchange for my €1. No. The swap simply means you go into a fixed exchange rate. Means as of now, today, let's say 1.5 euro equals to 1 USD. Let's say 1 euro equals to 1.5 USD. Okay, let's say this is the exchange rate today. What you worry is every month it changes. When it changes, then it affects your cash flow, inflow and outflow as well. Because if it changes every month, then it is very uncertain. So sometimes it goes up, sometimes it goes down. So what these two companies can do, Miller and Beck, they can agree on a fixed exchange rate. That means, okay, since we need each other currency, we agree to exchange at this rate. 1 euro equals to 1.5 US dollar. So every month we collect the money and we exchange. Okay or not? So if they are okay, then they reduce a lot of hassle. They don't need to go to a third party. Because the third party or a exchange rate or a currency dealer, they will charge a transaction cost. They will charge commission. But if you go directly between two companies, then you can save on this transaction cost, commission, and you can benefit both. Actually, it's a win-win to both companies. All right. So this is how currency swap works. So an alternative way to reduce exchange rate risk when it comes to funding or or debt financing is to adopt a parallel loan or a back-to-back loan where two parties provide simultaneous loans with agreement to repay at specific point in time. That means now Miller and Co, in order to make their fundings more perfect, they can actually agree to take a loan at the same time and they pay each other's loan. So if Miller borrow in dollar, but they are received in euro, and back borrow in euro, but they receive payment in dollar. Miller can help to pay back back's loan in euro. Back can help to pay back Miller's loan in dollar. So they pay back each other's loan because of their non-conversion of currency. That means back receive dollar, they pay Miller dollar for their loan. And Miller receive euro will pay back euro for their loan. So it doesn't involve any exchange or any exchange rate risk. Why? Because they don't exchange for any currency. What they earn, they pay. Right? So this is what a parallel loan can work to reduce, not to reduce any profit or increase any profit. No, we just want to reduce uncertainty caused by exchange rate because exchange rate is really uncertain. All right. So particular and exchange rate is very big impact because I know in few years back, Turkey, this country called Turkey, had a very bad exchange rate. Means that exchange rate depreciated a lot. So because of this low low currency cost, a lot of people went Turkey to travel. All right. And almost 10 years ago, this UK, United Kingdom, in pounds, their currency is very weak. So when their currency is very weak, a lot of people went to UK to study instead of Australia, because Australia was very expensive after currency conversion. All right. And why there are few people who travel to Singapore to travel? Be- Not because Singapore is not safe. No, Singapore is very safe and very clean. But why do you seldom go there? Rather than that, you go Thailand better, because Singapore currency is very expensive, right? It's about 2.53 3 ringgit to 1 Singapore dollar, right? So everything is 3 times more expensive. You go and have chicken rice, that chicken rice is $7. So for us, it's 21 ringgit as for one chicken rice, right? So this is how things work. So any questions so far? Anyone has any questions so far? Oh, any question? You're still here? Everyone okay? All right. So let's continue. Let's continue a short while. All right, so let's take a look at a parallel loan and how it works. Where if you look at number one here, loans are simultaneously provided by parent of an MNC to subsidiary of another MNC. All right, see. So there are two companies here, N Harbor and a British company. Okay, there are two companies, but Ann Harbor is a US company who opens a subsidiary in UK. So this is US and their subsidiary is in UK. And for this company, is a UK company, they open a subsidiary in US. All right. So if UK company want to fund a US company, or US company wants to fund the operation in UK, it involves conversion of interest rate or maybe loan. So if US need to loan to UK and UK need to loan to US, it involves an exchange of currency from pound to dollar or dollar to pound. So instead of exchanging the currency, they can look for a friend. Okay, they can look for a friend, and the friend so happen they open up subsidiary at the same time and the loan amount is the same. So what Ann Harbor can help British company is by, since they are in the US, they provide the loan in US dollar to this British company. Okay, for let's say a 2-year loan. Okay, 2-year loan. And the British company will provide a loan to the US company that started their subsidiary in the UK. So they help each other out, and by helping each other out, they reduce the exchange rate risk because now they don't have to convert any amount. Right? So at the specific time in the future, so that let's say the loan is a 2-year long loan, the loan will be repaid in the same currency that was borrowed. So that means if this company borrow in dollar, then after 2 years, they pay back in dollar. It's fine because they operate in US, they will earn US dollar and they can pay back the loan in dollar to the person who lent them. Same goes to this N Harbor who operates in UK. When they earn a profit after 2 years, they pay back the loan in British pound because they will earn in pound over the next 2 years. Right? So they actually reduce a lot of uncertainty. So an illustration of a parallel loan is like this. You see here, Chanel, this company, I think this is a US company, and the Malaysian government. Okay, these two, in year 0, Malaysian government gives 1 million ringgit, and Chanel gives Malaysian government 250,000. So this is the exchange rate, 0.25 per ringgit. All right. So in year 1, after 1 year, what happens? After 1 year, Malaysian government need to, because Malaysian government takes this loan amount, so they need to pay an interest of 7% of 250,000. So they need to pay interest of this 17,000 and the principal of 250,000. So Malaysian government borrow this 250,000 for 1 year. And Chanel also borrow 1 million ringgit for 1 year, and for 1 year it cost them 150,000 ringgit. Okay, 150,000. So they need to pay back 1 million ringgit and $150,000. So this is a parallel loan. So I lend you, you lend me. Why? So that we can offset any exchange rate differences throughout the year. So you can see that why are they doing this? So basically, they do this parallel loan in order to reduce any exchange rate uncertainty in the future. Okay, so in terms of debt denomination decision by subsidiary, in the case where subsidiary operates in a foreign country, what is their decision when they come to securing a debt? Which country's debt will they be taking? So if a subsidiary of a company decide to match the currency they borrow with currency they use in the product, their cost is dependent on the local interest rate. However, if a subsidiary in a host country where interest rate is high may consider borrowing in different country in order to avoid high cost of local debt. So an example means a subsidiary of a US company or in Japan. So in Japan, you might want to consider, do you want to take a debt in Japan or do you want to take a debt in US? So in most cases, subsidiary who operate in Japan, they will take debt in Japan. Why? Because not only interest rate in Japan is low, they will also generate income in Japan. So their income in Japanese yen is used to repay their debt, but cheap debt in Japan. Okay. Another example, if you operate in Philippines. In Philippines, you will generate income in Philippines. But one problem is if you borrow in Philippines, their interest rate is high. So if interest rate is high in the Philippines, then you might have an option whether to consider another country to borrow from or not. If interest rate in Philippines is high, maybe you might want to consider borrowing from Japan or from US for that matter. Right? But of course, if your inflow and your outflow is different currency, again there will be exchange rate risk, and you need to find ways to reduce this risk. Okay, so these are the cost of borrowing when you look into MNC, or the something that concerns multinational company, because you operate in different countries, where will have the lowest interest rate in terms of bond yield. You can see Japan is always the cheapest, very cheap to borrow in Japan, and very expensive to borrow in Brazil. So if your company were to enter Brazil and you need money to fund your operations, you might consider not borrowing from Brazil, because Brazil interest rate is very high, 16%. So when you operate in Brazil, you may want to borrow from Japan, but then again, if you operate in Brazil, you borrow from Japan, then there will be exchange rate risk when it comes to repaying your debt. And you have to consider how to manage it. All right. So these are the things that I want to highlight to you in this chapter. There are We are halfway through now. So shall we have a short break before we continue? All right. So we'll have a 10 minutes break. I'll see you back at 11:55. Okay. See you after the break. All right, welcome back. If you are back, just raise your hand. How about others? Back, just raise your hand. Not back. Okay, anyhow, let us continue. At the end of the lecture, I will provide this recording as well. All right, so in countries where the MNC operate having a high interest rate, they might have a split decision in terms of debt financing. So subsidiaries based in developing countries, especially, they may be subject to high local interest rate. So in this case, they might have a dilemma or a split decision whether should they take debt in the country that they operate, in the foreign country, or should they take debt from a cheaper or from their home country. So both has pros and cons. So in the country they operate, even though the interest rate is high, they can do a matching strategy easy. So they take on a debt which is high interest, but their income can be used to repay their debt. However, some parent of a US-based MNC may consider providing loan in dollar to finance a subsidiary overseas in order to avoid the high local debt. However, in this case, whatever the income from that country, it needs to be converted to pay back its loan in dollar, right? So that one incur lower interest rate, but will be subject to uh, uncertain future exchange rate. So you have a trade-off. Either you want to have high cost but zero exchange rate risk, or a low cost but a high exchange rate risk. This is the dilemma. So comparing subsidiary financing with local currency versus borrowing from a parent. So let's take a look at these two examples in terms of alternative 1 and alternative 2. So a parent company, let's say in US. Okay, so I will label this. Parent is in US. And they open a company in Mexico. And this Mexico company, of course, Mexico is a developing country. So let's assume that their interest rate is higher, okay, which is 12%. In US, interest rate is only 7%. So it makes sense that, oh, when you want to do business in Mexico, should you borrow in Mexican peso or should you borrow in US dollar? So if you go ahead and borrow in peso, in the local currency where your subsidiary is, you need to incur 12% interest rate. But as long as you take a loan in Mexico bank and you pay interest in Mexican bank, whatever balance you can pay back to the parent. Okay, the additional profit after interest and tax can be remitted back to the parent. This is in the case where they incur high interest rate but zero exchange rate risk. But in the case where they decide not to pay such a high interest rate, so they might want to borrow from the parent itself, US. This Mexican company now decide not to borrow from the local Mexican bank, but they borrow from the parent, which the parent will borrow from US bank to provide to the Mexican subsidiary. So they only incur 7% interest. However, this 7% interest is based on the US dollar loan. So US dollar loan converted to Mexican peso in order to operate in Mexico. And when the Mexican subsidiary makes profit, all the profit or a lot of the profit will be needed to be transferred back to parent in order to pay back their debt. So in terms of risk is much higher because a lot of their funds need to be converted. And if a lot of funds need to be converted, subject to high exposure to exchange rate. So in this alternative one, they only remit small amount of funds. So their exchange rate risk is minimized. But if you borrow from US, your funds that need to be converted back is a lot, so the risk is not minimized, it is actually quite high. So we are talking about risk here, not about return. Yeah. Okay, so one way to reduce this risk or to make things better is by employing a forward contract. So a forward contract is for you to lock in your exchange rate for the coming years or for the future. So forward contract may be available on some currencies for 5 years or longer, which allow subsidiary to hedge its future loan payments in a particular currency. So take a look at the alternative two. This one incur a lot of exchange rate risk. So how can you reduce that? You know, every year or every month, every period, you need to pay back how much to the loan. So you know that every month you need to convert this amount. So before you wait for the time to come to convert in the spot market, you can actually lock in whenever you feel that it is at a reasonable rate. You can lock in the price so that you can remit the funds uh, at zero exchange rate risk. Just like example, you plan that next year 2022 you need to travel to Hong Kong for work. Alright, you need to travel to Hong Kong for work, but then you don't know when. You don't know when you need to travel because very uncertain, right? So what you can do is you can book your air ticket in advance. Like today, if you book air ticket to Hong Kong, I think it will be quite cheap. You book the hotel in Hong Kong, also gonna be cheap. So you can book today, or you can wait until everything get better, and then you know that, oh, next week, let's say in May 2022, you think that, okay, this week is a good week to go to Hong Kong. So by that time you book your flight ticket in the spot market, definitely the price is going to be higher, and the exchange rate is also going to be different. So that is why if you do things in advance by employing the forward contract, you may remove a lot of uncertainty. So this hedging may not allow subsidiary to achieve lower debt financing because it is not a forward rate is not there to reduce the financing cost, but it is basically to reduce the exchange rate risk. Okay. So if MNC parent consider financing subsidiary in a host country where interest rates are high, it must estimate financing cost for both financing alternatives. So this is solved when you as an MNC decide to open in another country and the country interest rate is high, then you have to think carefully where should you get your funds to finance its operation. So comparison of two alternative loan with different debt denomination for foreign subsidiary. So so this is just an example of using Mexican peso as well as dollar. So this one they show you an example in loan payments. Either you borrow in Mexican peso or you borrow in dollars. Right, so this is in more detail lah. Basically, this is in numbers. This is in the diagram to show you. So the numbers will show you effectively how much you are going to pay. So accounting for uncertainties of financing costs, Subsidiary can create a point estimate exchange forecast by using sensitivity analysis. So not to say that if you borrow in foreign currency, you cannot estimate. You can estimate, you can forecast, but your forecast may not be 100% accurate. Not 100% accurate, but you can at least make some forecasts so that you are prepared for the worst. Okay, so an MNC can apply a simulation. You see, it's just like a what if analysis. What if exchange rate changes a lot? What if exchange rate doesn't change? What if exchange rate moves to your favor? So if you leave exchange rate unmanaged, you probably may profit more, you may not have any additional gain, or you may lose a lot. So a lot of MNC don't care about profit a lot or no changes in exchange rate. They are basically afraid that exchange rate might be bad. Okay, some they will provide a poor profit. So because of that, they can apply a simulation in which it develops a probability for exchange rate for each period with an outflow payment will be provided. So they try their very best to estimate and to show that in the future, whatever the exchange rate is, whether their inflow is sufficient for the outflow or not. All right, so very very simple. When you start working and you start to buy a car, and let's say you buy a MyV, and you need to finance the loan about 700 per month. Okay, so if you buy a MyV and you need to pay a loan 700 per month, you need to know that every month when you are going to get your salary, so that your salary can be used to pay your loan, right? You need to plan in advance. And in addition to this, an MNC is actually worried not only the repayment, but to know that whether the exchange rate will change a lot so that the payment will remain the same or the payment will be higher each period. So this input that is needed to conduct such an analysis will include initial investment needs, spot rates, interest rates, as well as expected revenue and operating expenses. So you need to predict well ahead of your MNC or your subsidiary operation for the next month or the next 2 months or the next whole year. And next step is by analyzing financing alternative. So maybe your alternative will not be just one. You might have more than one. And maybe you can find ways to reduce the exposure. And then next is to adjust the analysis based on different conditions. So this is one example of Lexon's project based on two financing alternatives. So what are their financing alternatives? This one rely on US debt based on 20 million borrowed and 20 million equity. And another alternative is based on Argentine debt of 40 million peso and equity of $20 million. So equity both the same, the debt level is different. Debt one is borrowing in USD, one is borrowing in Argentinian peso, I think. Argentinian dollar lah. Yeah, Argentinian peso. So if you look, their revenue is actually in Argentinian peso. Okay, that means this company is a US company based in Argentina. US company based in Argentina. So should they borrow in US or should they borrow in peso? So based on this analysis, we look at the end result, which is NPV. We see that after paying for debt, operations, and everything, we see that their NPV is much higher if they rely on the Argentinian peso. Okay, maybe Argentinian peso or Argentine interest rate. You look at Argentina's interest rate is much higher, 15%. Otherwise, they take a US interest, US debt is only 9%. So if you don't compare, you will say, oh, US will be cheaper because interest is much lower. But in the case where they borrow in Argentinian peso, they actually reduce the exchange rate risk. And in the end, exchange rate affected so much that actually Argentinian peso, although higher interest rate, they eventually gave you a higher net present value. So in the end, based on these two results, although Argentinian interest rate is higher than US interest rate, you borrow in Argentina as interest rate because the exchange rate will make it better. So the result will be to rely on Argentine debt. And next we'll be talking about debt maturity decision. So how long you are going to borrow. So of course, the longer you borrow, the higher the cost it will be, right? Because you always, based on the yield curve, the higher the maturity, the higher the interest rate you are going to pay. Right? So you assess the yield curve, whether borrow long, how much more expensive. Actually, usually you borrow a short term, it will be cheaper. And if long-term debt is too expensive, you may consider financing with loans of different maturity. So instead of borrowing for 10 years, you can borrow every 2 years or 3 years. You can. So you need to compare the cost as well as the availability of funds. So if you borrow from 3 years, what's the problem compared to borrowing for 10 years? You borrow from 3 years, after 3 years, you need to pay back and you need to borrow again. After 3 years, pay back again, borrow again. So you need to do that 3 times within 10 years. But if you borrow for 10 years, one shot, you do not need to worry about paying back in 1 year, 2 year, 3 year. You do not need to worry about availability after 2 years or 3 years. Right? So there are some quite dangerous. They think that, oh, 3 years debt is very cheap. So I borrow 3 years. After 3 years is up, then they need to borrow some more money. Then they notice that, oh, funds is not available. Cannot borrow. If you want to borrow, interest rate is very high. So this is the refinance cost. The cost for additional financing after the debt has matured. All right. So so fixed versus floating debt decision, again, this one is related to the first example I gave when I took a car loan, whether there is a choice for having a fixed or floating interest rate. When you consider financing with a floating rate, it will be best if you can forecast the rate for each year because it changes every year. Okay, and that will determine how much you will pay every year. And if you are able to forecast, then you may be able to determine the cost of financing every year. If you don't want this headache, then you just apply for a fixed rate. Okay, so hedging interest payment with interest rate swap. So previously there is a currency swaps, right? Swaps, that means we swap the payment. But now we can also swap interest rate. So how do we swap interest rate? Swapping interest rate is when MNC have an interest rate that will rise, they may complement the floating rate with interest rate swaps to hedge the risk of rising interest rate. So when a company decided to borrow floating and on top of the exchange rate risk, they might also have interest rate risk. So not only that the exchange rate will make them pay more, the floating interest rate will also make them pay more. So if this is the case, how can they prevent or lower the risk? So they may look for a financial institution who will act as a dealer, or what we know as a market maker, in order to facilitate these interest rate swaps. Okay, so in a plain vanilla interest rate swap, there will be two companies involved. One company will exchange a fixed payment for floating payment. Okay, so I'm not sure. Yeah, there is an example here. Okay, there is an example here. So this Quality Co, this company, actually borrow at fixed 9%. Okay, and Risky Co borrow at variable. But at one point in time, after borrowing fixed for some time, they think that fixed is a bit high. Quality Co might realize fixed payment is a bit high. So I want to swap my fixed rate to a floating rate. Can you? You can, but you need someone to pay the fixed amount for you. And for Risky, they have been paying variable rate or floating rate, but now they think that variable rate is a bit risky. So they want to change to a fixed payment. But because the debt is still there, they cannot just close out their debt. So how they can swap the payment method with each other. So Quality Co and Risky Co, they meet a dealer. So this dealer will help them. The dealer will come into an agreement for them and say, okay, Quality, since you want to exchange your fixed to variable, and Risky, you want to change your variable to fixed, okay, you pay them to me. So Risky company, you want to change to fixed, so never mind. You pay me fixed, okay? Pay dealer fixed. The dealer will use this fixed amount to pay Quality Co, so that Quality Co can use the fixed payment he received to pay their investor. So basically, Quality and Risky, they swap payment method, whereby Risky, instead of paying variable, now pay fixed. Now Risky will pay the debt of Quality Co. And Quality Co, who is paying fixed, now he wants to pay floating. So instead of paying fixed, he can pay floating to dealer, and the dealer will pay the floating to Risky Co, and Risky Co can use the floating amount that he received to pay their investors. So this is a win-win situation for both of them, right? So this is what we call as an interest rate swap. So do you have any questions so far? Okay, yeah. All right. Let's move on. However, interest rate swaps is actually quite time consuming and also quite troublesome, because you need to find someone who has the same requirement. So like Risky and Quality, these two companies so happen they have the same needs. So when they look for the dealer job is easy. It's just to match them up. But if quality coal at that time, they need something and risky coal is not there. So they may not have someone to swap. So this is like marriage lah. Marriage. So you need to have a suitable swap candidate and suitable terms in order to negotiate the swap. So other types of interest rate swaps, there are many types lah. Basically, accretion, amortizing, basis, and callable swaps. These are different types of interest rate swap, but basically you are just swapping the terms of an interest payment. There will also be forward swaps, puttable swaps, zero coupon swaps, and swaption. So all these instruments, forward rate, swaps, these are actually contracts. And when you deal with contracts, the International Swaps and Derivative Association is an association, is a global trade association that represents all these leading participants in the privately negotiated derivative industry. So usually when dealing with all these swaps, your cash flows, your amount involved is very huge. And in order to prevent any future disputes, the association will be there to help. And the two primary objectives of this association is to develop and maintain derivative documentation to promote efficient business conduct and practices, as well as promotion of the development of risk management practices. So we can't deny that over these years there are more and more globalization of companies. Means MNC is becoming more and more common. You don't just sell things in one country. Usually when a thing is very successful, it will be sold around the world. So companies will start to open branches, subsidiaries overseas, and they will incur a lot of exchange rate risk. So when they know about this exchange rate risk, they will try their best, or they will find methods to reduce this risk, and they will come across instruments that can reduce their risk. These instruments including swaps, forwards, futures, and options. So all these will help them to reduce this risk, but at the same time, the contract must be done properly as well. So the summary of this chapter would talk about MNC subsidiary when they are about to use debt financing. We don't want to talk anything about the interest rate that they are borrowing, but rather the inflow and cash flow that will be used to pay their debt. All right. So where you borrow your debt and where you obtain your profit will be a very big matter. It's a very big issue, because if you take your debt from Japan and you generate profit in another currency, then how are you going to pay your debt in Japan when it is due? You don't even have yen. How do you pay your debt? So an MNC subsidiary will always have choices where to get their debt. It can be local, where they operate, or it can be foreign, or anywhere that they feel that the interest rate is lower, they can take. But of course, again, risk is there. Risk of repayment and so on. So long-term financing, you might consider in taking from any country, but the ultimate goal is whatever decision you make, whether to borrow from high interest rate in local currency or low interest rate in foreign currency, it all comes down to the net present value. It doesn't matter where you get your debt from, doesn't matter whether it is high interest or low interest, as long as the risk is manageable and eventually it allows your NPV to be maximized. Net present value is high, then it's good enough. All right. So, and when we talk about floating and fixed exchange rate, floating and fixed interest rate, that is also another matter, because floating and fixed interest rate will incur another risk, and the risk will be interest rate risk. And how to manage this interest rate risk when the time comes, you may have or may need to employ these uh, swaps. Okay, so this is basically all for this chapter. Do you have any questions so far?